Okay, I'm very excited to have on the Goldstein on Gelt show, New York Times bestselling author Dan Solin. He wrote an very interesting book called The Smartest Retirement Book You'll Ever Read. Now, Dan, a lot of people try to be smart about retirement, but everyone seems to have a smart idea. How do you recommend people can figure out which are the smart ideas and which are kind of the scams? Not to be cynical, of course.
So first, thanks so much for having me on your show. It's a great pleasure to be here. I think most people complicate investing for retirement, and the best way people can invest for retirement is by having a broadly diversified portfolio of index funds and capturing global market returns instead of engaging in stock picking or market timing or trying to find the next hot mutual fund.
Okay, so one of the problems when people try to be smart, however, is they see all sorts of advertisements or ideas, and they're very tempting. What do they do to avoid falling into those traps?
Well, I think they have to understand that nobody has the ability, as far as I can tell, to predict the future direction of the market or to identify stocks that are mispriced. These are pundits who get on and have an agenda of their own. So a lot of good investing is just ignoring the noise and sticking to some basic principles and educating yourself about sound, responsible investing. There are many books, including yours, that tell people how to invest, what to do, and what not to do. And I wish more people paid attention to those basic principles.
So where do you feel it is that people, or why do you feel it is that people fail to do that?
Well, I think first, certainly in the United States, I'm speaking, primarily here because that's where I understand what's going on. The securities industry is a very powerful marketing machine. Its interests are in conflict with the interests of individual investors. So the interest of a broker is to generate commissions through trading, and also to sell complicated products like all kinds of structured products and derivatives that are many people like me believe are meant to be sold and not bought. So when you see all this advertising and all this marketing, and it tempts people to just do something, when good investing should be about as exciting as watching paint dry. So again, it's really ignoring most of what you see and hear and sticking to a basic plan. And that's where most people go wrong.
Okay, so I of course agree with this concept, but sometimes people get so tempted to do something. For example, they'll say, listen, before the crash in 2008, everyone was buying houses and, you could buy a house with no money down. And, people said, as soon as my maid said that she owns 3 properties with no money down and collects the rent, I realized we were about to have a bust. And so I decided to sell, or I should have sold then. Certainly in retrospect, a lot of good ideas are very obvious. And it tempts people to try to beat the market. Is that a reasonable way to approach it, or are you just no chance of beating the market kind of guy?
Well, I don't think it's fair to say there's no chance of beating the market. Let's look at what the smartest investors in the world, let's look at their track record. We find over here that every year about 1 in 3 mutual funds, 1/3 of the mutual funds, and these people have enormous resources, they beat the market. But there's no telling which of those funds will continue to beat the market. They don't have what's called persistence. When you look at the track record of hedge funds, these are supposed to be the smartest people in the world. Over the last decade, their average returns haven't even kept pace with inflation, and investors would have been far better off investing in an S&P 500 index fund. So if you look at the track record of professional investors, it doesn't give you much confidence that trying to beat the market is an intelligent investment strategy. So I don't understand why so many people attempt to do so.
Mm-hmm. Let's go back to something you mentioned a minute or two ago called structured products. A lot of times I also have found that these are so complicated that, I think complexity is really the enemy of the average investor. But why do you feel, sometimes they look very polished and good, things like you'll make the amount of the market, but your principal is guaranteed. Why are these not a good idea?
Well, first of all, most complex products are structured by the securities industry. They're not even understood by the people who are selling them. They tend to be high commission products. They're often illiquid. And just let's go back to basics. If an investment is promising a return over what's called the risk-free rate of return, which here would be like short-term treasury bills guaranteed by the full faith and credit of the U.S. government, then there's risk associated with that. It's just basic economics. If somebody's promising you a high return, you should assume that there's a high risk. And these complex investments promise a high return, but when you understand the costs involved, it's very unlikely that you're going to achieve those returns. I personally just view them as a wealth transfer scheme that where money goes from people like you and me who earn it to brokers who sell these products, and therefore they should be avoided.
Yeah, we should talk about wealth transfer. We're talking with Dan Solin, who is a New York Times bestselling author. He's been teaching people about how to manage their money. He also, by the way, teaches advisors about how to help people the best way. In fact, in our conversation, I'm hearing from you that it's not that you're against people getting advisors to help them, but you're concerned that people are being sold products that aren't appropriate for them. Is that what I'm understanding?
Yes, I think advisors can play a critical role for most investors, and the role that they should be playing is assisting investors with their asset allocation, the division of their portfolio between stocks and bonds, because that's really what's going to determine their returns in the future. Helping investors come up with an investment plan, because most investors don't have one, and then giving investors the discipline to stick with that plan in good times and bad. Those are the functions of a competent advisor. Note that I didn't say that the function of an advisor is to help investors beat the market through stock picking, predicting the direction of the market, et cetera. And so if advisors stuck to those basic rules that I just articulated, they're performing a very, very valuable service for their clients.
Yeah, thank you for saying that, because it was just the other day someone said to me, they said, given the new administration coming in, what's the likelihood that Donald Trump will be impeached, and how would that affect my portfolio? So I said, I really don't know. And they said, well, you're in the field, so you should have a better idea about this. And I said, I really have no idea what the likelihood is that he would be impeached. I thought it was so funny, and I was very honored that they thought that I was like a biblical level prophet. But I think exactly what you're saying is so true. If clients tell their advisors or expect their advisors to be able to know what's going to happen tomorrow, there's such a huge miscommunication going on here, and the advisors certainly shouldn't indicate that they are able to do it, and the clients shouldn't even be asking for it, because that's just not possible. That's critical. But let's touch again on this issue. You spoke about passing wealth, but instead of passing wealth from clients to the advisors, tell me about the issue of passing wealth from, let's say, a husband to a wife, or a wife to a husband, when one of them passes away, because a lot of times people are concerned that they're actually going to impoverish their spouse upon their death. What should people be thinking about in order not to do that?
Well, that's a somewhat complicated question. I mean, I don't know the laws in Israel, but here there's a lot that people can do to pass wealth from one generation to another. I mean, this involves how you title retirement accounts so that they pass automatically, whether accounts are held jointly or in your own name. This involves really estate planning. And one of the things that I find here, and I'll be very interested, Doug, to know if you find this in Israel, with advisors tend to get paid based on assets under management. When people buy insurance, that actually reduces the assets under management that the advisor gets paid for. As a consequence, over here, I find many people are underinsured. And I can't tell you the number of sad conversations I've had with widows who have to go back to work or sell their homes because their husbands did not have adequate insurance. So if husbands are genuinely care about the well-being of their beneficiaries, and particularly their wives, or if the wives are the major bread earners, they should have the same mindset. They should really take a hard look at what would happen if they die, and do they need more insurance?
So you're talking about life insurance, or what really should be called death insurance. You're not talking about all these other insurance products, are you?
Correct. I'm talking about life insurance, which for most people, term insurance is the way to go. But there are situations where whole life insurance is appropriate. But I find that the whole area is not discussed enough by advisors. So I think people should just should go through a drill. And that's another function that a good advisor will do. Say, okay, let's assume, as difficult as it is to have this conversation, I die. What will happen to my wife? What are my assets? How will taxes affect my estate? Do I have adequate life insurance? I mean, that's a drill that everybody should go through if they genuinely care about the other person. The way I got myself to do it, because none of us want to do this, is I heard something on, again, it was on National Public Radio over here, where the advisor was saying, you're being irresponsible if you don't do this. And that just struck a chord with me. So I amended my ways and did it.
Yeah, I think that's very true. I think one critical takeaway from what you said is we're talking about a specific insurance, which is life insurance. In general, as I agree with you, term life insurance in most cases that I've seen is the most appropriate. We're not talking about all these other insurance products, many of which, and I've recently been dealing with this for a number of clients as well. You know, people will buy all sorts of insurance policies that they don't really need, that they can afford the risk themselves, and they never really collect on because they're so complicated. The nice thing about a term life policy is it's very black and white, and you can collect the money, or your spouse collects the money if you should die, and that's the big test. Those policies that I've dealt with personally have always been the very easy ones to deal with. So it really is critical. And the way that we've tested it in doing financial plans for clients is exactly what you said. We'll say to a client, let's build your financial plan, and then all of a sudden stop the income from, let's say, the husband, and see what will happen. And then we can say, but what if you got $1 million payment at that point? Then how would your plan look? And that's one way you can actually test, and the clients begin to feel what it's actually like and what their cash flow would be like after the breadwinner passes away.
So that's all excellent, and your clients are lucky to have you. I mean, that's a great way to approach it, and I wish more advisors did it the way you do it.
All right. And Dan, we've been lucky to have you here on the show. Unfortunately, I see we're out of time, but just tell me in the last few seconds, how can people follow you and follow your work?
So I blog every week for the Huffington Post and also for a trade blog called advisorperspectives.com. My webpage is www.danielsolin.com.
Okay, so we will put links to that at the show notes of today's show at goldsteinongelt.com. Dan Solin, thanks so much for your time.
Great pleasure to be with you, Doug. Thanks so much for having me.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.